What do we got here?
From chaos to clarity.
Ooh,
beautiful.
Okay.
We have
probability
poets.
and numbers of occurrence.
Didn't know our research boys were into poetry. That's nice.
They use spell
From
check.
chaos to clarity.
All right. What do we got? Go ahead. Give it
All
to
right.
me.
Probability and number of occurrences. So according to the law of large numbers, the average of the results obtained from a large number of trials should be close to the expected values and will tend to become closer as more trials are performed, meaning you flip a coin once or twice or 3 times, you might not have the 50% probabilities.
Could be all heads, could be all tails, even though each independent occurrence should be 50-50. It could be all the same.
All the same. And that is not out of the realm of possibility. Once you get more occurrences, you get closer to those probabilities. So that's what we're talking about in the second, paragraph here. At casinos, they usually cap your bets. You don't want to get lucky on one occurrence versus longer durations where you have lots and lots of occurrences.
Sure.
And that's just an example of the law of large numbers playing out as the house is usually profitable in the long run.
Yep.
Of number of occurrences. So similarly, trade small, trade often is our mantra for the number of occurrences playing a huge role in trading. And we're going to look at a number of different things here that kind of validate that sort of situation.
Okie dokie. Let's take it.
All right. So looking at one specific occurrence, this is just our couple of coin flips. Between April 21st and May 2nd of this year, SPY never had a down day, meaning that if we were bullish, we would be correct every single day, 100% win rate. It's amazing.
That's correct. It is amazing.
Is that normal?
You wouldn't think so.
100% win rate? That's normal?
You wouldn't think so. Unless you're Tom.
Of course.
And then you get on somewhere.
Yes, me Lord is always right. So 10 and some change percent was the upside move. You had 100% win rate. However, this does not mean that a SPY position will go up every single time. There are always deviations. And so how do we minimize deviations? We look at that over time. And because this can go against you. If you were short this whole time, now you're a 0% win rate. So it's both ways.
Sure.
Wins, losses,
yes,
all that stuff. So
that is correct.
You can get 10 tails in a row or 10 heads in a row. It's still the same thing.
That is correct.
On to the next slide here. So slide 3. So winning and losing trades, to explain the deviations, you consider the following portfolio with a majority of winners. It is highly possible that in a sample of 3 trades, they are all losers. They could also be all winners. Just talked about, circled in the blue there. However, with more occurrences, the results tend to be closer to the expectations. And we can look at that in the next slide here. We just go to the next slide. Slide 4. It's just a quick one.
Slide
4.
So
this is the one we mentioned with the trend trade.
When we were talking, ago, yes.
Yeah, a moment ago when we were talking about fast market, when you're talking about trend, opening up, down, this, that. This looks like a mirror image. Right? Like the downs and the ups.
Yeah, you got a little bit extreme on one moment or another. But
they're both, there's extremes on both sides. There's not, if you told me to pick out, a section of this, I would tell you that they're probably the exact same. They're pretty equal here.
They're very equal. They are.
Yes, and so this is SPY day-to-day change over a massive period of time. And we were looking at 24 years here. Mm-hmm. I mean, you're looking at 2000 to 2024. This incorporates, 08, the Volmageddon, COVID. It's all baked into this. It looks very much the same here, both sides. As
certainly does, my son. Yes, it does. I would give it to you for sure.
Thank you. When we go over to the next slide here, so we go to the 5th slide here. So the market experiences large changes when sampling a small number of days. This is your tail risk. This is your lucky bets, all that sort of thing, all those sort of things. However, when the number of days increases, we experience mean reversion, the average percentage change in the SPY and the standard deviation, and just generally up versus down days, they start to get to be basically what we would expect, a 50-50 on a day-to-day basis here. The longer we stay in the market, the more our returns will level out and cancel out any huge changes to the downside over time. Again, this is why we talk about trading small, trading often, because if you have 10 trades and you can only have 10 trades, you might have 10 losing trades in a row. You need to be able to have the 1,000 trades, 10,000 trades, 100,000 trades
Yes.
if you're that sort of
Yes.
player. So,
Yes.
you can look the average percentage change in the SPY over a 10-day period. If you just took, random baskets, certainly skews to the upside. It's a relatively big percentage. When you look at the all days, when you look at 25 years of data, it's basically zero, on a longer time frame. So, and that's even more apparent with the standard deviation of the moves. And so this is how wide your distribution is, going from, over 1% to basically 0.2% there. That is your deviation of returns is getting much, much tighter, which if we go to the 6th slide, this is exactly what you want when you think about this from your P&L standpoint. So let's go to slide 6. And we'll look at the slide 6, maybe. And we'll come on. I'm
going for
channeling,
slide 6.
I'm channeling my Tom. He gets a little more testy. He's like, John, next one, John. Come on.
It's very testy.
Very, very testy. No. Don't go to the takeaways yet. Oh, now, now you mess. Okay.
Showing the power, the power that he has over you.
You have a little God complex
Which one would
out
you
there. He's laughing. He's got a little God complex. I hear you, John. All right.
John, well played. It's about time you fought back. You know what? Now do it when Tom's in here.
Yeah, seriously. Seriously. All right. So when you look at probabilities and number of occurrences here, when you look at less than 100 occurrences, and this you should look at from a P&L standpoint for your own portfolio. Mm-hmm. If you're doing, a couple trades, you're going to have these wide P&L distributions.
Yes.
Big losers, big winners, or just the, P&L swings from winning to losing are going to be really, really wide. I don't care about the percentages there, the win rate or whatever. As you get, more occurrences, your expectations tighten up. And if you have, positive expectations over a period of time, you can start to, project that out and be more comfortable with your trading because your deviation of returns gets much tighter.
Totally agree. Good job.
Next slide here now, John, we could go to the take.
We really are looking at numbers of occurrences, trading small and trading often here. We've looked at this numerous times. It's a great little refresher here. This has been very good on a Friday when you've got volatility, up 6% and the S&P is down 50 to do a market measure on here about size, because we're talking about number of occurrences, but it really equates back. You look synthetically, we're talking about size here and keeping your size in check for your portfolio.
Yep, exactly. So we need to remember that we are trading in a random environment. There's always that random variable, the unknown. It's beautiful. That's why trading is here for us.
Yep.
You can't trade if everything was known.
Mm-hmm.
So even though we have expected probabilities, it's going to take some time to realize those results. Just because you lose 3 or 5 or 10 or 50 trades, it doesn't mean that the probabilities are wrong or that something's against you. It just means that you haven't hit the number of occurrences that you need to get to that point. Trading small and eventually obtaining a large number of occurrences are two ways we can combat the random acts of the market and ensure we maintain a proper amount of capital in our account. And this goes for winning trades too.
Absolutely.
So some people come and they start and you get 10, 20, 50 winners and you think this is the easiest game in the world. And then you start sizing up and then things change and all that stuff. So it's always on both sides.